Hey guys, so in this video, we're going to break down the marketplace financial model that we've built on Slidebean. If you haven't watched our general financial model tutorial, make sure to go and watch that one first, because I'm not going to cover the basics of the spreadsheet on this video. I'm just going to focus on the projections and the stuff that's specific to a marketplace business. And what is a marketplace business? In the end, a marketplace company is a company that's connecting buyers and sellers. Who are sellers? For example, Airbnb is connecting renters with people who are traveling, right? So the buyers would be the travelers and the sellers would be the homeowners. eBay is connecting people that sell items, so very obvious, the sellers and the buyers. So a marketplace business model could really apply to a bunch of different things. And we've made the model flexible enough so that it could apply to any of those. You can even charge a subscription to your sellers if that's applicable to your company. But let's get started with the sheet. So like I said, most of the work is going to happen here in the projections section, where we're going to have the sellers and the buyers. So let me walk you through the variables. Once again, all the other sheets have been covered already in the previous tutorial. All right, so we have a marketplace launch date that you can set to any date in the future. Let's say that this is going to launch in January. All right. Okay, so one thing about any online business is that you're going to drive traffic through many different channels. And in this model, we've grouped them into 3 or 4, I believe. The first one is organic traffic. Now, the special thing about organic traffic is that depending on your model, organic traffic could drive both buyers and sellers to your platform. So, for example, Airbnb, using that example, has a lot of organic traffic, and a lot of people just come to Airbnb and become an Airbnb renter without having to do any marketing budget, just because the brand is well known, as well, of course, as renters or travelers. So there's going to be an option to set a brand awareness budget. So this is going to be your general brand awareness campaigns for the company that inevitably are going to drive organic traffic. Now, one important variable here is that these numbers are not connected. So you can literally set your brand awareness budget to 0 and still expect that you're going to generate some organic traffic, even though that would probably be unrealistic. The point is, the budget is not connected to the traffic, because with organic traffic that could vary a lot. You could be, you could be getting people via PR or SEO, and the budget doesn't necessarily correspond with the amount of people coming to your website. For the amount of people coming to your website, you can set a launch date for your organic traffic efforts. That launch date could be different from the platform. So you could say, well, maybe in the first couple of months, we don't expect a lot of organic traffic. We're just going to be building the brand, and then we're going to delay this a little bit. What's the website traffic at launch? How much percentage-wise does this grow? And then what's the cap for that? If you do 10% month over month without a cap, that's just going to become an astronomical number, and it's going to drive unrealistic expectations. Depending on what you're building, that maximum possible monthly traffic should be capped, again, based on your business model and the specific marketplace where that belongs. All right, so let's look into the sellers. Before that, sorry, you can go to the revenue sheet, and then you'll be able to track organic traffic here. So whatever you set, again, March 2021 was the launch date. This is where your organic traffic comes in. And it grows, and then it's capped at 100K visitors. All right, so let's look at sellers providers. These are the people who sell things on the marketplace. How do you acquire them? So there are 3 ways in which you can acquire your sellers. One is with organic traffic, as we discussed. So what percentage of your organic traffic becomes a seller, a merchant on the platform? Right now it's set to 0.1%, simply because probably most of the organic traffic is going to be the buyers, not the sellers. Then you're going to have paid seller acquisition. So you can set this to a starting marketing budget, maybe $10,000. Let's set it to 5, increase it by 1,000, and then to a maximum of 100,000. So this is going to determine how many people you drive into the platform to sell. The expected cost of acquisition for a seller, that's the cost of acquisition for a seller. So, at 500, that means that you'll be bringing 10 sellers the first month, and that's going to be increasing by 2 sellers every month thereafter. You can set this to 0, by the way, so you can assume that you're not going to be doing any paid marketing. Maybe your sellers are very complex, and you don't need to. You won't be able to acquire them via marketing. You'll need to acquire them via business development. So that's the third option here. Business development lets you assign a position. Right now, it's the outbound sales agent here in the teams and salary sheet. And that one is actually a different color. You can change the name, but you should always use the same position. So the position in charge of that reach out is the outbound sales agent. The new agents added per month is 1. You're increasing that by 1 every month, all the way to a maximum of 10. So what you're basically saying is that you're going to start growing a team from 1 person all the way up to 10. The annual salary for that onboarding sales agent is going to be $50,000, and then you can even assign a sales commission for the seller. So if you go to teams and salaries, that's just going to equal what you add here. Let's say that you're going to make a smaller sales commission and maybe a bigger salary, so that will automatically translate into teams and salaries. And then finally, the number of sellers added per agent per month, that's 1. You could say that that's 5, and then you could say that each one of your salespeople is going to bring 5 new sellers into the platform every month. Again, it really depends on the type of business. Normally, not all of these 3 might be applicable. For example, in an Airbnb, I would expect that maybe at the very beginning there were some salespeople trying to convince people to list their homes, but after that, there's no need for a sales agent. All right, then seller onboarding. So once these sellers are convinced, either by marketing or by organic traffic or by business development, how long does it take for them to be onboarded? You can add a delay on this. So you could say, well, it takes 2 months for a seller to kind of be on board. Maybe they have to list their photos, list their products. If you're doing like a marketplace, it's probably going to take 3-4 months while you match the inventories and all that. So you can set a delay. You can add a cost of onboarding a seller, and that would be optional. So you can say, well, a seller is going to cost, we're going to charge $500 for a seller to join the platform. Let's set it to $1,000. And then there's going to be a churn rate, which means how many sellers do you lose every month? Meaning, if you have 100 sellers in a given month, that means that you'd be losing 10% of those for the next month. So that means that 100 sellers translating to 90 sellers for the next month, and so on, out of that cohort. All right, so that's just the seller acquisition part. So let's see how this is looking as of now. So we're saying that the platform is launching in January. We're saying that we're getting organic traffic starting March, because that's when organic traffic started. But paid marketing actually started on the launch date for the main platform. So that's the sellers added from paid traffic and the sellers added from paid agents. That gives us a total of 15, 22, 30, and so on. Then we're adding a delay. So that's the month delay that we're expecting. I believe that this is set to 1 at the moment. Let's see. 1, yeah, so you could set this to 0 if you want to assume that there's no delay on this. There we go. So that just gets transferred the same month. And then you have active sellers, and that number is growing. And then you have sellers lost due to churn, which is just the rounded 10% churn, which is pretty high, but again, it's going to vary by industry. Okay, so that's just the number of sellers that you have on the platform, and that's an important number to track because that's going to drive a bunch of other things, but we'll get to that in a sec. Okay, so now let's look at the business model. So how are you going to make money from sellers? You can set up, you can charge them that first-time setup fee. So when you're saying, what we're saying here is that you're going to be paying $1,000 to onboard a seller. Maybe that's, say, Uber Eats, for example. They probably need to spend some money to onboard a seller while they go and take good pictures of their food and whatnot. So you can set those costs as a cost to you, but you can also charge them an onboarding fee. Then you have a commission. So how much of a commission are you taking from them per transaction on the platform, if that's a flat fee, or what percentage you're taking from them as a percentage of the amount billed. So this comes from the seller end, not from the buyer end. It's not an extra cost that customers pay. It's a cost that you take away that you don't transfer to the sellers eventually. So let's say that you're going to be charging $0 per transaction and maybe 10%, a 10% fee. All right. And finally, you can also charge them a subscription. So it depends on the type of platform that you have. You could set a monthly membership fee to be a seller in the platform. Shopify would be an example of this, where you have to pay Shopify $29 a month to have a store, and then you charge them a commission and so on. So you can literally build the Shopify business model on this spreadsheet. So the final revenue for the business, since it's going to be derived from the number of orders and the amount of orders happening, is inevitably going to be influenced by buyers. So actually, this business probably makes very little money if it just has sellers, maybe the subscriptions, but that's it. The rest of it depends on orders. So let's get into that. So here's the buyers section. So there are two options here on how you're going to acquire these buyers. There's going to be buyer acquisition done by you, by your company, and there's going to be buyer acquisition done by the sellers themselves. So if you say, for example, Shopify, there's really no buyer acquisition done by Shopify. Everybody sets a store and they promote their own store. So you don't have to worry, or Shopify doesn't need to worry about bringing customers in to their customers' stores. They're only monetizing on the sellers, but that's one exception or one type of a model. For Airbnb, for example, most of the revenue is actually driven by Airbnb. People go to Airbnb, that's the brand that they know, and it's very rare that a house renter will find their own guests to stay, right? So we actually let you model both on this model. So buyer acquisition done by Slidebean. Just like before, you can do that acquisition via organic traffic. So you could say X percentage of buyer traffic converts. Let's set this to 5. You can do paid marketing. So you can say, well, just like before, what's the starting marketing budget? How much am I increasing that budget month for month? And what's the maximum budget that I'm willing to spend in these buyers? Let's set this number, really high so this company can scale bigger. Okay. And then the expected cost of acquisition for a buyer. This is potentially going to be cheaper because these are customers. They're probably buying goods or services. They're not sellers, right? Which are a much rarer type of user. Okay. So the buyer acquisition, you can also estimate repeat purchases. So out of the people that have purchased something, how many of them are willing to come in and do a repeat purchase? We're going to look into that in a second, but there's going to be a churn rate, meaning the number of people that you would consider active on the platform. This would be, you could maybe this consider or estimate something like eBay, for example, where eBay buyers, some of them are very active and they make multiple purchases a month, but some of them don't. Some of them just come in and leave right away. So what percentage of them are recurring buyers is what we're asking here. And then we have the fees for buyers. So these are the fees that come on top of the pricing, right? You could set a transactional fee, maybe a service fee. Let's set that to, $2.5, something like that. And then percentage fee. So we could set that to 5%. Finally, last but not least, we have the number of orders. So what number of orders each active customer creates every month. We're setting 1.5. And then what's the average order size? 108. Let's set this to 100 and so we can kind of look at how this order breaks down. So here's a breakdown of the order. So the average order size, we're saying it's $100. We're charging $2.5 to buyers on top of that. And then we're charging a 5%. This is about my bad here. This should be percentage. We're charging a 5% on top of that. So that's $5. Oh, actually, no, this is correct. It's the 5% amount, but since it's 100, that's why it's the same number. All right. And then the total bill to customer is $107.50. That's the invoice. That's, in the end, the revenue that the company would collect. But then you have to pay that out to the seller, right? So what's the commission taken from the sellers? We said that was 0, the flat, but then there's a 10% commission on the order, so that's 10, meaning that the total earnings going to the seller are 90. The money that you made from orders is 18 because you're charging the 7.5. Sorry, the gross profit per company per order, that is 18 because it's what you're charging the buyers minus what you're taking away from the sellers. My bad. Sorry, that was not 18. So the gross profit for the company per order is 17.5, which is what you're charging the sellers, so the commission that you're taking from them, and what you're charging the buyers on top of the original price. So the original order is 100, but you're charging 107, you're getting 17.50 back. That's a 17% gross margin per order. So that's great. Last but not least, before we check out how this looks, we have the option to add additional buyer acquisitions done by the sellers. So for example, if you assume that the sellers themselves are going to be bringing their customers, they're going to be bringing their traffic through your platform, you can set an estimate number of orders and an estimate order size. That number could be different from the other one. The orders per month, right now let's set it to 0. Let's assume that all this traffic is going to be driven by you. Maybe you could set it to 0.1 even, or 0.225, which means that every few months, you're going to expect that there's going to be an order coming from the sellers themselves, but not on a permanent basis. All right, so finally, the purchase billing, and this one's probably the hardest one to grasp, which is who is charging this? Who is charging for the transaction? In Shopify, for example, the store owner is connecting their Stripe information or their billing information into Shopify, which means that the credit card charge is happening on the customer side, on the seller side, excuse me. So the seller connects their billing system and they charge the customer. And then you take a percentage of that, you take a percentage commission from that money. On the other hand, on Airbnb charges the full price and then they transfer the money to the homeowners. So that's the difference here. When you say who bills the buyer, you can set that to the seller, which I think is going to be more rare in the models that you guys are going to be building, which is again the Shopify model where they're going to be connecting their billing information, or the company. That means you, the company, are the one that charges everything and then transfers that money to the sellers. But that makes the financial model look very differently because on the company, you're charging a bunch of money. Your revenue is going to be through the roof because you're charging literally every order. And then you have a lot of cost of goods sold because you're transferring that money away. While if you set this to the seller, you're only going to be perceiving the money that really corresponds to you, so the commissions themselves. But the revenue, the total revenue is not going to be counted in your books. All right, so let's set it to the company, which is what we're going to be using. And let's look at how this looks. All right, so we have buyers. The marketplace launched in January, so we say that we have 10 buyers acquired here on January 2021. That's the first month, and they came from paid marketing. None from organic, because remember, organic only kicks off until March. Then we have the active buyers, meaning how many of them are going to become recurring customers. We're saying that there's going to be a churn rate of 15% on those, so that's when this churn rate is accounted for. But right now, we consider that there are 10 active buyers, the ones that came this month. And then on average, we're saying that each one of them is going to set up 1.5 orders, which means that the revenue from these orders is going to be $1,500. That's $100 per order. Great. So these are the ones generated by you, right? By the company. You can also have the orders that are generated by the sellers. We're saying that, it's less than one order per month, but since we have 20-something sellers or 15 sellers here, we're still getting some orders from them, even though not everybody is bringing one order per seller. That'd be aggressive, right? To say that each seller brings a large multiple of orders. So make sure remember that that's an average. And then we have a revenue from seller-generated orders that'll give us a total revenue. Great. Okay. So now we have fees per transaction. So these are the fees that you're charging to the customer, to the buyer. So on top of the price, and then the percentage of the order, which is, again, the part that you're charging on top of that price. So that gives us a total of $2,000.15. There are some decimal numbers here, which we're simplifying, but you can enable them if you want. And that's why this is a decimal number. So that's the total revenue that you collected. Now that this is enabled, we can go back and see what the seller fees look like. So we have setup fees. Remember that we enabled that. We told sellers that they're going to have to pay to join the platform. I think it's $500. We have the subscription amount, if you want to do that as well. And then the transactional fee. So this is the important part. You were saying that you're going to be charging 10% of those orders. So 10% is what you're going to be charging, which means that your revenue is going to be the sum of all this stuff. Now, an important part here is that you need to write this revenue off. You need to kind of pay out the sellers, and then that's done on the cost of goods sold sheet. So if you go here and you scroll down, what we've added here is the seller payouts. So out of that revenue that you made in January, the vast majority of it is actually going to the sellers themselves. Because they're the ones selling their products or their goods. So if you go to a financial statement annual, you're going to see that you're going to make $1 million in revenue very quickly, but you're going to be paying that out, a big part of it. And then your net margin, your gross margin looks something like this, which is in the 11%. This is affected also by your credit card charging fees. That's important. So the cost of goods sold, you have payment processing costs, which you can also control here from projections. So on payment processing costs, we're saying that there's 2.9% transaction, which is what a normal credit card merchant will charge you. So that's important that you take that into account here. That out of that 5% transaction fee, you have to account for that stuff. So this business looks negative there's a negative gross margin at the beginning, probably because of the setup fees. If we go and delete that, let's see. because you're saying that you have to pay $1,000 to onboard a seller. But if this was free to you, then that margin would probably be positive a lot sooner. There you go. And actually, the margin increases a lot just by removing that cost. Great. So the last part that's a little bit cool, like if you're doing a business that deals with shipping, for example, a marketplace, a merch type of marketplace, so you can add third-party logistics here, and you can enable this. This is disabled by default, but you can say that what percentage of orders require third-party logistics, meaning shipping, drop shipping, and all that stuff. Let's say that 10% of the orders require, or 100%. What's the fee per order, and what's the direct cost? This is very simple. You're saying, well, I'm charging on average $15 per order, but it's really costing me just $5. So if you go to revenue, you're going to have that as an additional revenue source, just on the number of orders that require third-party logistics, the revenue that you collect, but also in the cost of goods sold, the cost of delivering that. So here's the third-party logistics direct costs. So that's that. A lot of people have been asking for this model. It's been long requested, mainly because of the complexities, right, associated with connecting one with the other. But hopefully this is an insightful tutorial to you. Let us know if you have any questions in the comment. We'll try to get to those. And enjoy the model. Link in the description. See you next week.